Hello and welcome to the first webinar that's part of this year's Smart Money Week in Agriculture, brought to you by the University of Nebraska-Lincoln Center for Agricultural Profitability and Nebraska Extension. I'm Shannon Sand, Extension Educator and Agricultural Economist with the Center for Ag Profitability. Through webinars held at least once a day this week, Ag Smart Money Week aims to equip farmers and ranchers with the tools and strategies to improve their financial management and risk management to build success in their business. You can find the full schedule and registration information on the Center for Ag Profitability's website, cap.unl.edu/smartmoney. This webinar on balance sheets is a great place to start the week because balance sheets are so important to building your financial foundation. This webinar will show you how to build and interpret balance sheets using real farm examples to track assets, liabilities, and net worth. You'll learn how balance sheets show you where you stand financially, how lenders view balance sheets, and how to make important calculations. To present, we're glad to be joined by Jessica Oh my God, Jessica, I can't say your name. I'm sorry. To present, we're glad to be joined by Jessica Groskopf, an extension agricultural economist with the Center for Ag Profitability based in Scottsbluff. Jessica welcomes any questions during the presentation to be typed into the chat box or the Q&A box. Jessica, thank you so much for joining us today.
Thanks for having me, Shannon, and it's okay. I stumble occasionally too, and it's my own last name, so
It's
there we go.
Monday.
Well, welcome everybody, and I'm so excited that we're going to kick off this week talking about balance sheets because it's such an important part of knowing and understanding where your farm or ranch business is and will assist you as you come into year end and thinking about what kind of changes you might be making in your operation and how we can improve your farm or your ranch business. So I'm a pretty visual person, and I'm going to be sharing the analogy of a picture today because that's what a balance sheet is. A balance sheet is basically a picture of your operation at a point in time. So it's the snapshot, if you will, of your business. Now, if you're like me, when you were a kid, your mom used to take all of your school pictures and used to line them up side by side. Well, that's what your banker is going to be doing with a balance sheet. They're going to be looking at the progress and progression of your business over time. And we know that sometimes when we're taking pictures, sometimes we look better and sometimes we look worse, just depending on the day. And the hope, though, is that over time, we're improving that business. Okay. So same thing happens with those balance sheets is that there are times when that business is struggling a little bit for a specific reason. Sometimes we're going to make corrections to that business that might make it look worse today, but will look better tomorrow. And so that's what your banker is doing as they look at your balance sheets, is looking across those snapshots. So today we're going to really dive into, well, what specifically are they looking at within that snapshot that tells them whether the business is doing good or is getting worse. So, for example, we can think of it as we can look and see, are your eyes clear? Is your skin clear? Do you look happy? Those kinds of things. Now, does that tell us the actual health of the business? No, it's not the full story, right? But it is a good indication of what's happening within that business. So just to recap, a balance sheet is a snapshot of your business's financial position at a single point in time, right? Just one moment. This is what it looks like. And it's a list of everything your business owns, which we're going to call assets, and everything your business owes, which we are going to call liabilities. Now, if you've never made a balance sheet before, this is the first time you're doing it, take a piece of paper, fold it in half hot dog style, and all you're going to do is on the left-hand side of that piece of paper, you're going to list everything the business owns. Okay, so we're going to think about our operation. Does it own land? Does it have buildings? Are there cattle, equipment, Those kinds of things are all going to be listed on the asset side of that balance sheet. On the right-hand side, we're going to list liabilities or debts. So what do we owe someone else? And we are going to list everything that we owe someone else. Okay. Now, occasionally, I will see balance sheets where lenders will ask you to also list your personal assets and liabilities. Okay. So they're not just looking at the farm or the ranch itself, they are also looking for you as a person to be added to that. Okay. Typically, these are listed in different areas on the balance sheet. They're separated from the farm and ranch assets. And if you're entering this into a document that they provide you, usually they'll have separate what they call schedules. Okay. Know what your lender is asking for, whether they're just looking for your farm or your ranch, or whether they are also going to ask you for the personal. The other thing is a lot of farms and ranches these days have multiple entities. So you might have an LLC or a partnership or a corporation, and you might have multiple of those. They might be asking you for identifying what's owned by what entity. Okay. So when you go and you sit down with a lender, ask exactly what balance sheet they're looking for, because the LLC is a separate legal entity, right? That may be different, and your land may be owned in a different um, structure or by someone else. Okay, so go in and ask, how do you want this all listed? And be very clear. I like to add lots of notes to balance sheets so that the lender knows exactly what they are looking at. All right, so we're going to dive into assets and liabilities a little bit deeper. So you took your piece of paper, you made the list. Now we need to know more information about what you own or what the business owns. So at the very top, do you have any cash that the business owns, checking accounts, accounts receivable, and hedging accounts? That typically is at the very top, the first things that we list. And you're going to need to know the current balance of all of those accounts. And there might be more that exist, but this is where we start. Then we're going to find out what the current inventory of things like prepaid expenses and supplies on hand, investment in growing crops, and any crops in the bin or market livestock that you have. And finally, we're going to find the current inventory and value of breeding livestock, machinery, titled vehicles, land, buildings, and improvements. Okay. So really, again, this is everything that we own, and we need to know, what do we own and what is it worth? Right? Now, there are two ways to value these assets, right? Valuing assets, especially when we talk about the current inventory on breeding livestock, machinery, titled vehicles, land, and buildings, we really need to think about, what is it really worth? Okay. So there's two ways that um, lenders may ask you to list the value of these assets on your balance sheet, and some might even have you value it both ways. So we're going to talk about those values. Those assets can be valued by the cost value or by the market value. So let's start out by talking about cost value. Cost value is the purchase price, what it costs you to purchase that item, less any economic depreciation. Economic depreciation. This is different than tax depreciation. Okay. What you report to the IRS, typically for farms and ranches, is an accelerated depreciation, which means that we're taking advantage of the tax law to allow us to write off that piece of equipment more quickly. Okay. Economic depreciation is, we're going to actually do it as close to the true depreciation as possible. So, what is depreciation? Depreciation is the wear and tear over time that depletes the value of an asset. In particular, we are going to depreciate machinery, vehicles, buildings, and breeding livestock. Okay. So, depreciation, wear and tear of that asset. Okay. So I love the example of a pair of shoes, right? When I get a brand new pair of shoes, they're worth this much. But the moment I wear those shoes, I start to break them down. And if they get to be like the shoes on the screen, at the end of their life, they're really not worth a whole lot, right? But each wear of those shoes causes the value of them to decline. And we can think about the assets that we as farm or ranch owners have, that with every use of that piece of equipment, with every calf that cow births, right, her value declines over time. Okay. So again, this is the cost value. This is only one way to depreciate assets. Again, depreciation is the wear and tear, and economic depreciation is different than what you're reporting to the IRS for accelerated depreciation. Okay. All right, so how do we do depreciation? Here's a really great example. So basically what we're going to do to depreciate out an asset using economic depreciation, there's different methods to do that. I'm just going to show you one today to keep it simple and keep us moving forward. But this is a straight line depreciation example. So basically we're going to take that purchase price, the original value of the asset, and then we're going to figure out how long we think that that asset will last. We're going to call that the asset life. And then we're going to say at the end of that asset's life, what will it be worth? And we call that the salvage value. So in the example, we purchased an asset for $75,000. We think it has a 10-year life, just to keep the number simple here. And we think at the end of its life, it's going to be worth $15,000. So I take 75,000 minus 15,000, that's 60,000. I divide that by 10 years, which means that that asset will depreciate about $6,000 per year. And so as I get those subsequent balance sheets every year, I'm going to subtract $6,000 from the value of that asset if this was the type of depreciation I was using. Okay, so that's cost value. Let's talk about market value. Market value is probably more common, but I want you to be cautious with this. Market value is the value that is placed on an asset that a willing buyer will pay for the asset. Market value is what a willing buyer will pay for the asset. So again, if I'm looking at cost value, that's kind of a continual decline. When I look at market value, is the market for that asset going up or going down? So used equipment is a really good, interesting kind of study in this right now, right? Because used equipment market values have remained pretty strong, even though if I'm using cost value, that value is declining over time. So market value is a useful tool, and your lender may provide a market value for commodity prices and cattle automatically, okay, so that they can see what's happening not only across your business, but across all of the lenders that they have within the bank, okay? But they typically don't provide like a market value for like a standard market value for land. Every individual farmer or rancher will have an individual market value for land based on the qualities of your land. Okay. Again, know what type of value they're asking you to put on your farm or your ranch business, and they will recommend, do you want me to put a cost value on that balance sheet, or do you want me to put a market value on the balance sheet? Here's where I think it gets interesting. Again, land is an interesting study in the difference in cost value and market value. Here we had a farm that we bought for 100 and basically $53,000, and today it's valued at almost $300,000, right? So that just shows you, know the difference between a cost value balance sheet and a market value balance sheet, and know what you are using on your balance sheet, because it can make a big difference in how your business looks on the balance sheet. Now, a lot of times you are asked, what do you think this asset is worth? And I want you to be really cautious here, because if I'm using market value and I decide to bump up that market value a little bit, just a little bit, what we're potentially doing is putting a filter over that snapshot, right? We've all seen the filters that are out there that can do some crazy things. So if you are adjusting the asset values on your balance sheet, do it with your banker's guidance, and be cautious not to overinflate those values. Okay. Because what happens is you don't want to be in a position where you get overstretched because you inflated those asset values. So again, take care when valuing assets and make sure that you take notes when you adjust those values. And in fact, if you're using a market value balance sheet, we don't often adjust those values, and I would only do it under the recommendation of a lender. Okay. Let's hop to the other side of the balance sheet. I don't see any questions coming in, so I think we'll keep moving. So let's talk about the debt side, the liability side. Liabilities are everything the business owns. And again, sometimes these are called obligations. Most commonly, it's your debt. Okay. And debt is basically you owe someone money, you need to repay money that you borrowed. And one of the biggest mistakes that I see farmers and ranchers making on their balance sheet is they are not listing all of the debt that they have. This is a big mistake, and you need to list all of the debt regardless of who the debt comes from. So if you owe the neighbor $5,000, you need to make sure that's listed on your balance sheet. If you have multiple lines of credit, for example, maybe you have seed, chemical, or equipment dealers that are offering you a line of credit, all of that should be listed on that balance sheet so that whoever your primary banker is, they can see all of the debt that you currently have. Okay. The other one is credit cards. See a lot of farmers and ranchers using credit cards. I think that's okay. I think it can be a useful tool, but they don't list if they have credit card debt on the balance sheet for the business, and that should be included if that exists. Okay. All right. So why do we use debt? And debt can be a useful tool for many in agriculture. It is a useful tool, and we use it when we don't have enough cash to purchase an item outright. So for farmers and ranchers, we only get paid maybe once, twice, 3 times a year, and so we can utilize something like a line of credit or a credit card to help us get between basically those paychecks or those calf sales or those grain sales. The other reason that people use debt is that the cost of the loan is low compared to what their money is earning in another investment. Now, it's probably not as common today, but if we think back a few years ago, we could get a low interest rate loan at 3 and 4% versus having an investment that's earning 8, 9, 10%, right? So there might be situations where you have debt, but the interest rate on that debt is so low that you are actually making more money by leaving your money in an investment rather than paying off that debt. And if you're curious about this particular slide, actually, I think last year we did a series talking about family living expenses and debt. And I did a whole example of when to decide to pay off debt or not based on the interest rate and the potential earnings. Okay, so we're filling out our balance sheet. What do we need to know? What do you need to know? What are kind of the what's the language around debt? So you need to know what the principal balance is. That's how much money you borrowed and then how much you've actually paid off. Okay, so if you have money that you've borrowed, maybe you've made some payments, we need to know what the balance is remaining. You need to know the term of the payment, how much time you have on that debt. So, for example, do I have a 30-year loan? Do I have a 20-year loan? Do I have a 15-year loan? That's the term. And then the interest rate. And occasionally this will be listed as the APR or the annual percentage rate. This is the amount of interest that's charged on the principal balance. Okay, so on the principal balance, and there may be additional fees associated with that debt. But for the most part, most ag operations, these are the key pieces of information that you are going to need to know in order to be able to accurately complete your balance sheet. Okay. All right. So we've taken our piece of paper, we've listed everything out, we have a value on all of our assets, we've listed all of our debt, and we know how much we owe for each debt. Now what we're going to do is we're going to organize all of that information. And most farm and ranch balance sheets basically have three um, sections, for a lack of a better term. There's current assets and liabilities, and these are assets which we expect to turn into cash or are cash currently within the next year. Debt that we need to pay within the next year. So that's current. Intermediate has a life of 1 to 10 years, and long term has a life of greater than 10 years. So once we've got this information organized, we're going to subtotal each little block you see there on our balance sheet. So I'm going to have a total current assets. I'm going to have a total current liabilities. I'm going to have a total intermediate assets and a total intermediate liabilities, total long-term assets and total long-term liabilities. Okay. Occasionally, I will run into a balance sheet that will lump intermediate and long-term together, and they will simply call it non-current. Okay. Not a big deal, just a little bit of different language, but the overall structure is the same. Okay. So, just to kind of help you organize, these are the things that should go in each block as we look at that balance sheet. Okay. So again, start working through that list, make sure that you can work through it. And if you want a copy of these slides, they'll be available when the recording is posted within the next 24 hours on our website at cap.unl.edu/webinars. All right. Okay. Let's start talking about why the heck is it called a balance sheet? And I think it's important to think about this and how when we buy something new and potentially take a loan for whatever we bought, how does that look on a balance sheet? So I'm just going to use a house as an example, just to give you an idea. So I have a mortgage, and the fair market value of that house on the day I purchased it was $400,000. I put $50,000 down. So I have a loan of $350,000, and basically that calculates out to a little over $2,500 a month in payments. So just to give you an idea, remember that every payment we make slowly decreases the amount of money that we have due, right? But the payments typically are consistent over time. So this happened to be, where I made those payments and the amount of the payment is the same over time. But what happens is each payment is made of interest and principal. Okay. Of interest and principal. To be able to fill out my balance sheet, I have to know that what the payment is, but also how much I'm decreasing the amount of the principal loan balance. Okay. So super simple setup here. I bought the house, right? So how do I add that to my balance sheet? So a house has a life longer than 10 years, so it becomes an asset that I own. Okay. So I'm going to put that house, and on a day I buy it, I'm going to add the asset value of $400,000 because that's what it's worth. But how do I list the debt? So the debt gets listed in two places. There's the debt that's due within the next 12 months. So that's going to go at the top in my current liabilities. And the principal balance of the house is going to go at the bottom, right? And kind of weigh out or even out that long-term liability. Okay. So as you go through this process, it's really easy to go down your asset side and say, okay, is there any debt associated with that asset? And make sure you put it in the right spot on the balance sheet. Okay. Now, over time, the value of the house will increase and the principal balance will decrease, but the annual payments in this example will remain the same. Okay, so if you're going to update a balance sheet, remember, if we're revaluing assets, the value of that house hopefully will appreciate over time. But as I pay off that debt every month, the amount of the principal balance goes down. Okay. All right. So that's why we call it a balance sheet, because we have to balance our assets with our liabilities. Okay. Now, you might be sitting here going, yes, Jessica, but I might have more assets than I have liabilities. So that doesn't quite balance out. At the bottom of every balance sheet, we will calculate a net worth. Okay. And that actually is what makes it balance. So at the bottom of every balance sheet, there's going to be the equation. It's highlighted in blue. Assets equals liabilities plus net worth. Okay. Another way to think of this is net worth is the difference between the assets and the liabilities. So occasionally you'll hear this called owner's equity, and that means that's what the owner owns within the business that is not associated with debt. Okay. So the owner's equity in the business is the value of what the owners have within the company. Okay. Now, net worth is kind of an interesting number. If it's negative, we are not in a good financial position. If it's positive, we are in a good financial position. But how do I know what's good? Based on net worth alone, I can't tell you that. Someone can have $1 million worth of assets and zero liabilities, and therefore their net worth would be $1 million. Someone could have $2 million worth of assets and $1 million worth of liabilities and still have $1 million of net worth. So it's important to know that net worth is one of the measures that we look at, but the number alone can be generated from lots of different values of assets and liabilities. So we have to dig deeper to know more about the health and well-being of your business than simply looking at the net worth. But every balance sheet will calculate your net worth. Okay. So again, net worth is the amount of the business that does not have any debt associated with it. You as the owner own that 100%. Okay. All right. So we have completed developing our balance sheet. Okay. So that snapshot, that picture really comes out once we have this balance sheet developed. Now, another recommendation is that you prepare your balance sheet at the same time every year. Okay. Let's go back to our snapshot analogy, especially with kids. Is it fair to compare a picture of the first day of school to the first day of January? Not necessarily, right? If those two pictures are of those kids, there's at least 3 months worth of growth, 3 to 4 months worth of growth between those pictures. Okay. So when we're looking at balance sheets, I encourage you to prepare at the same time every year, because we could be at a different point in the production cycle, and that can throw off how the balance sheet looks. Okay. So prepare your balance sheet at the same time every year. I prefer a January 1 balance sheet. Okay. Now, a balance sheet is only one of the financial documents that we're going to be talking about this week. So I encourage you to come back and watch the cash flow and the income statement discussion as well, because balance sheets actually are really, really helpful when we're looking at your cash flow and your income statement. I always think of them as kind of the bookends of your financial documents. So again, balance sheets are snapshots. So kind of at the beginning of the year, the cash flow shows you how money flows through the business, and the income statement shows you the money that comes down to you as the business owner, and we determine net farm income from the income statement. Okay. So my colleagues are going to talk about those more in depth later this week, but these all work together. And so if I have a January 1 balance sheet and I have a 2025 statement of cash flow, I can also match those documents up and make sure that we've got everything correct. And that will also show up in the 2025 income statement. Okay, so when I have them all matching, it just makes it easier to assess the business. Okay. All right. So I told you that net worth is something that we calculate, but it doesn't show us necessarily the health and well-being of the business. So what does show us the health and well-being of the business from a financial perspective? So there's an organization called the Farm Financial Standards Council, and it provides standard financial guidelines for farms and ranches. It allows for comparison across businesses. So again, it's standard whether they're looking at your ranch or your neighbor's ranch or a ranch in Montana. Okay. And what it does is help us monitor the financial health and performance of farms and ranches across the US. And currently, there are 21 standard measures. Now, not all of these measures come off of the balance sheet, and today I'm only going to be focusing on 3 of those ratios that we can use. But remember, there are 21. So if we look at these 3 ratios, we might dig deeper into your financial documents to look at whether or not your business is financially sound. So here are the 3 ratios that we are going to be looking at. It's working capital, current ratio, debt to asset ratio. Okay, those are the 3. Working capital and current ratio, we're going to be looking at the very top of your balance sheet, and we're going to be comparing current assets and current liabilities. And this is really telling us whether or not your business is liquid, which means can the business meet the financial obligations as they come due this year? Basically, can you pay your bills this year? Okay. The debt to asset ratio is a solvency measure which says, can the business pay all of its debts if it were all sold tomorrow? So over the long run, can you handle the amount of debt that you currently have? Now, you'll notice that there's another category of ratios here called profitability. And I don't have a profitability ratio listed to discuss today. That's because a balance sheet does not show profitability. We don't look at your balance sheet to see whether or not you are profitable. We look at a balance sheet to see whether or not you can service the debt that you currently have with the assets that you own. So again, it does not show profitability, it shows liquidity and solvency. So let's jump into each of these ratios. So again, it's working capital, current ratio, total debt to asset ratio. So like I said, on these first 2, we're going to be looking at the very top of your balance sheet, and working capital is current assets minus current liabilities. So again, can we pay the debts that are due this year with the current assets we have? This is another one of those because it's just a subtraction. There's a lot of different ways that we can get to this number, okay? If it's negative, we're in trouble, right? We're vulnerable. If it's positive, we're in an okay place, but how much money do I need? What makes me look good? Well, we can't tell that from calculating just the current, from just looking at the working capital. What we have to do is look at the relationship between these 2 numbers, and we do that by calculating a current ratio. So instead of just looking at it as one minus the other, what we look at it as is current assets divided by current liabilities. Okay. So this time we're expressing this value as a percentage rather than just as a sole number. Okay. The way I like to think about this is when I take my current assets minus my current liabilities, it tells me the relationship between those 2 numbers. If I do that, and the value is less than 1.3, I'm in a vulnerable position. Okay, that means I have $1.30 of assets or less to cover every dollar of liabilities. I want to be better than that, right? I want this value to be higher than 1.3. If it's between 1.3 and 2, I'm in an okay financial position. If it's greater than 2, I'm in a good financial position. Okay. So again, current ratio, because we're looking at the relationship, tells us more, and that allows me to look at different sized farms different farms in different parts of the country, different types of farms, but it's standard that we want it to be 1.3 or larger. Okay. Now, this time, assets is on top, liabilities is on the bottom. So the bigger the number, the better off we are. Okay, the bigger the number on a current ratio, the better off we are. All right, let's talk about debt to asset. Debt to asset ratio here is looking at all of the assets and all of the debt, not just the current portion at the top. Okay, so again, we're doing this just for the farm and ranch assets. We're looking at them all. So what we're going to do, and watch this, okay, watch this because it's tricky. We put liabilities on top this time and assets on the bottom. So we want this number to be smaller. We want this number to be smaller. And the way I think of this is how much of the business does your bank or your lenders own? Okay. So what percentage of your business as a whole is associated with debt? Okay. So it's the ability of the business to pay off all of its debt. If this number is greater than 60%, we're in a vulnerable financial position. If it's between 30 and 60%, we're okay. Depending on where we're at in that, we may want to make some adjustments. And if it's less than 30%, we're in a strong financial position. Okay. Now, I want to remind you with these ratios, again, it's just like looking at that picture. It doesn't tell me why the business is the way that it is, but it's indicating some financial strengths or weaknesses that we may need to address. Okay. Improving your balance sheet. So you've gone through this process, we've developed the balance sheet. Now we're looking at these three key ratios and you say, okay, well, how do I improve that balance sheet? There's several ways that we can improve the balance sheet. One, we can sell assets for more than they are valued on the balance sheet. Okay, so let's say that the lender comes in and they price corn at a certain value. Well, if you're able to sell corn for more than it's priced for on your balance sheet, then we're improving that balance sheet over time because we're generating more income from that corn than the lender expected us to. Okay. Same thing with equipment or cows, right? They're valued at this and I can sell them for that, the better off I am. I'll talk about refinancing on the next slide, but refinancing is basically redoing your debt, redoing your loans, delaying capital purchases. Maybe you had you were on an equipment trade-in schedule, and you were thinking, oh, we should continue that. Well, we need to improve the balance sheet. Maybe we're not going to trade in that equipment this year, and we're going to hold that equipment because we can't take on more debt to upgrade. Okay. Reducing personal withdrawals. So if you are gaining family living expenses from the farm or the ranch business, maybe we can slow that down or reduce the amount that we're taking on a regular basis. But I think that's a pretty low hanging fruit. I think usually when someone comes to me and they have a challenge in their balance sheet, I'm going to look at the business, not just the personal, to correct where we're at within the business. And finally, we're going to sell off unprofitable or unnecessary assets, or we're going to use those assets more efficiently to generate income, such as custom farming. All right, I want to dive into refinancing a little bit deeper. And so basically what happens is we can go in and refinance those loans. And so this improves our cash flow by reducing the current liabilities by lowering either the annual payments, by renegotiating the terms of the loan. So we can do that in two ways. We can extend the length of the loan, which reduces the size of each payment, or we can reduce the interest rate on the loan. Again, I think it's a little bit harder now to reduce the interest rate just based on where interest rates are at. So most of the time, or right now, what we are probably seeing are, if you're going into refinance, is extending the length of that loan. Okay. Okay. Just really briefly, I do want to talk about farm bankruptcy because we have seen farm bankruptcies increase recently. And so for right now, farm bankruptcies are not forgiveness. Say that again, farm bankruptcy is not forgiveness. It's a repayment plan over 3 to 5 years. Um, the individual or the spouse must be engaged in the operation. You must have a total debt that does not exceed that $11 million number. Um, if you want more information about this, you can check out information about Chapter 12 bankruptcy from the U.S. court system. But do know that farm bankruptcy um, can be a tool, but I think the biggest thing to know here is that it is not forgiveness. Okay, and if you need more help with that or information, feel free to reach out to us here at Nebraska Extension. So overall, improving your balance sheet is about increasing your assets and decreasing your liabilities. Um, we do have some time here. Make sure we do. Yep, we got about 20 minutes left. So I was going to go through a couple of examples of what happens from both sides, right? If you happen to have some extra money where you put that money on your balance sheet, what that can do to each of these ratios. But I'd also encourage you as we start to wrap up our webinar today that if you have any questions, please feel free to put them in the chat or into the Q&A, and I'm happy to answer those questions as they come up. So let's run through our example. And this gives you an idea of if you come to work with someone here at the Center for Ag Profitability, kind of how we'll work with you through your balance sheet in particular. So here's an example balance sheet, and honestly, I'll probably stick your balance sheet into an Excel file, and I'm going to calculate your working capital, your current ratio, and your total debt to asset ratio. So here's a pretty simple balance sheet as we look at it. This person has $5 million worth of assets and $2.5 million worth of liabilities. But as we look at their balance sheet, if we look at their current assets on the top, they have $100,000 of current assets. So I'm going to use a grain farm as an example. Maybe they have some grain in the bin, they have some cash on hand, and they have some crops, if this was a few months ago, that are growing in the field, right? But if we look at their liabilities, they have $90,000 worth of liabilities. So the working capital is positive, right? $100,000 minus $90,000 is $10,000. But the current ratio here is in the red. It's 1.1. Okay. So that means they have $1.10 of assets to pay for every dollar of liabilities. Now we wanted that to be closer to 1.3. So it's going to be tight essentially for them to make this year's payments based on how their balance sheet is currently structured. Okay. So let's just say for whatever reason, they come up with an extra $10,000. Okay. Maybe here's a good example. Maybe we got some extra government program payments and they're wondering, what should I do with this extra $10,000? Okay. Now, they could have received $10,000 for their business from other means, right? They could have sold their grain for more than it was valued at. They could have sold a piece of equipment that wasn't listed on the balance sheet. Somebody could have gave them $10,000. Okay. Government payments is a good example because I think some of us weren't expecting some of the payments we received this year. Okay. So I'm going to show you three options of where they can put this $10,000 on their balance sheet and what that does to each of these ratios. Okay. So the first option is that they could put it into current assets. The second option is that they could pay off current liabilities. And the third option is that they could put it into intermediate assets. Okay. So let's walk through the example. So if they put $10,000 into current assets, that changes the top of our balance sheet, right? So we added the $10,000 to the current assets. So now our working capital goes up from $10,000 to $20,000. We calculate the current ratio and it improves their current ratio to 1.22, which is better than it was. This also improves their net worth, okay, because we increased our assets. We didn't add any additional debt, which means we also increased our net worth, and we slightly dropped our total debt to asset percentage there by 0.1%. Okay. So on a total debt to asset um, measurement, it doesn't really do a whole lot. Where it really changed was that current ratio. Okay. All right, let's look at two. Let's pay off current liabilities. Now, the funny part is most people say, well, Jessica, shouldn't it be the same? Not necessarily. Usually paying off debt improves your ratios more than adding assets to the asset side of your balance sheet. So in this example, rather than putting it into their current assets, they paid down $10,000 of their current liabilities. So dropping their current liabilities from 90,000 to 80,000. Okay, still have $20,000 worth of working capital, but now my current ratio is improved more to 1.25, getting us closer to that acceptable range of over 1.3. It reduces our total liabilities this time, increases our net worth, and again, very minutely improves that total debt to asset ratio. Okay. All right. The last one is, boy, they thought, I could upgrade a piece of equipment. And so they went to town and they bought a $10,000 piece of equipment and they just paid $10,000 for whatever that is. They didn't take on any additional debt here. So when we look at this, what it does for them, it doesn't do anything to their working capital, doesn't do anything to their current ratio, and only slightly improves their debt to asset ratio. Okay. So here's the summary of what happens. So as you come into preparing for your loan renewal, as you think about maybe some tax implications, maybe you're on the cattle side and you have a little bit more money than you thought you would this year. Think about where we can put that money and how it looks for improving our balance sheet as a whole. I would encourage you, I know sometimes it's tempting to purchase additional assets to reduce our tax liability, but we have to know what that's doing to our balance sheet. So take this opportunity, especially on the livestock side, if you have the opportunity to really shore up and strengthen that balance sheet, that you do that today. So with that, I'll take any questions from the chat or the Q&A. Happy to answer anything I can, and looking forward to some great questions that come in. So thanks. Shannon, what questions do we have?
I don't see any yet, but I will go ahead and ask a question of you while we wait, if that's okay.
Yeah, go ahead.
So you mentioned like if someone came in, you would probably put it in Excel sheet or whatever, but for them at home, is there an Excel sheet you recommend or are software available and is there training available for some of those software as well, potentially? If they just want to be able to pull their own balance sheet at like any time.
So what I highly recommend is working with whatever sheet your lender is providing. So most banks will either have some sort of like online portal where you enter this information, or they will send you an Excel file that
Mm.
they use for their sheets. Now, tools like Quicken and QuickBooks
Mm-hmm.
have balance sheets within them, but I don't think they're as user friendly. And so I'm a big Quicken user, but I actually don't use the balance sheet within Quicken because it doesn't do as good of a job of tracking physical assets like
Yeah.
buildings and land. It does do a good job of the accounts, like the bank accounts, investment accounts, those kinds of things.
Mm-hmm.
The other piece to that is, again, what are you developing the balance sheet for? So if you have multiple entities and you have personal within these softwares, is it just doing everything or is it pulling up that individual entity? So that can be something that's important when you're deciding, what
Mm-hmm.
sheet to use. If you don't have a lender, let's say lucky or in a position, let's say
You're
that's probably,
self-insured or something
yeah.
like that where everything's paid off kind of deal.
Yeah, and you're just
Okay.
curious, you've never put together a balance sheet before. Several extension services across the country offer free balance sheet templates. I think Michigan is the one
Yeah.
that I'm most familiar with. And so you can use any of those. I really like it when the balance sheet automatically calculates some of the ratios that I showed you today. That's something I think is important.
Yeah. Good job. Okay. Well, do you have anything else you want to add, Jessica? Because I don't see any questions coming in right this second.
I don't, but again, if you need assistance preparing your balance sheet or you have questions about refinancing or firm bankruptcy, please do not hesitate to reach out to me or anybody else here at the Center for Ag Profitability. My phone number and email are on the screen, and I'm happy to help in any way that I can, even if it's just I need a second opinion of your balance sheet. I'm happy to take a look and see what I can see from the information that you provide. And the last thing I'll leave you with is your balance sheet is only as good as the information that you put into it. So again, I encourage you to take the time to go back and look at your balance sheet, look at the values that are there, um, do the calculations,
Hmm.
and really it's your farm, it's your ranch, and at the end of the day it's your business. So make sure that those numbers are correct and they're not just put together by your lender.
That's a good way to look at it. So, well,
Okay.
thank you so much for joining us today during Ag Smart Money Week. Free webinars will continue through Friday, and you can find the schedule and registration information at cap.unl.edu/smartmoney. Jessica, thank you so much for joining us and have a great afternoon.